One of the lesser known indicators that many Forex brokers offer is the demarker indicator. The demarker indicator is simply an indicator that's used in technical analysis that compares the most recent price action to the previous candle's price action, attempting to measure whether or not there is a substantial amount of demand for the currency pair. The demarker indicator is often used to identify if there's a chance of price exhaustion as well. For example, if you are in an uptrend and the demarker indicator shows that there may not be as much demand, then there's real risk for a trend change at that point in time. The oscillator is normally bound between the 100 and negative 100 levels. And unlike most other oscillators, it doesn't use like a smoothed or averaged set of data to show what's going on. It simply uses raw numbers. One thing that you can use use it for is the riskiness to try to decide whether or not the current price and the riskiness of a trade could go against you. For example, down here, as price was falling, you can see that the demarker actually had gotten pretty low, and at that point in time it would have warned you that perhaps shorting wasn't the best thing to do, as it was well under the 40 mark, showing that there is a possibility that exhaustion was about to happen, and that's exactly what happened. Of course, you can see that there is a nice strong trend on this, and as such you can see that the move just continues. And on this daily chart, you can see that every time that it gets a little higher, price started to drop, and that is the underlying demand being measured. It's demand in one direction or the other. It is a little bit different in the stock market. It does tend to follow price a little closer. In the currency market, it's just measuring demand in general, either up or down. So that is a slight bit different than you would use in the stock market. For example, stock market traders would like to see the demarker maybe up in the 60 range or something like that as they buy a dividend paying stock. Now, the reason being is because although dividend paying stocks you buy for the dividends in the long term, having nice steady prices in the dividend ensures that your dividend yields will be roughly the same as time goes on. For example, if it's 4% and the price doesn't move one way or the other, then it will continue to be 4%, assuming that the company continues on with that. One way Forex traders can use the demarker as well is in the scalping environment to see whether or not there is a high likelihood of steadiness in the pair. And the higher it is, the more likely that's true. And if it is steady, then the scalper can go in perhaps on the 5 or 10 minute chart and scalp the markets accordingly.